Welcome back, everybody, and in today's video I'm going to be breaking down how to identify imbalance. Simply, the market doesn't do exactly what we want it to do all the time. It doesn't always come exactly back to our institutional candle. However, there's an area right before our institutional candles called imbalance, an area that we can look to play off of. So let's simply just jump to my computer and I'll break down exactly how you can identify it and how you can play off of the imbalance. Now, at the moment, we are taking a look at AUD JPY on the 4-hour time frame. If we look at the market right now, what is it doing? Well, if we look to the left, we can see it is creating and has already created relative equal lows. Now, what does that tell us? Well, as you all should know, there's a ton of money underneath the equal lows. So we're expecting the market to come below and take all that liquidity. But once the liquidity is taken, we want the market to go ahead and reverse back up to the upside very quickly. And as the market reverses back up, we're expecting to see some sort of imbalance. So let me play the market out real quick. You can see there goes that pump and dump to take all that liquidity to the left-hand side. And then what happened after that? We immediately had a huge turnaround back up to the upside. So that tells us that smart money is inside of this market. They're manipulating the market to steal all of your money. They sold the market up here to take the liquidity and now are quickly pushing the market back up in the other direction. Now, when this happens, you must understand when the market is moving fast, it won't last. But when the market is moving slow, it will grow. Now, what that means is when the market is moving super fast, it creates imbalance. And now imbalance also stands for insignificant price action. Okay, so what does that mean? Well, the algorithm, the market moves off of ticks. Like it is ticking and it has a algorithm that it needs to follow. But when smart money pushes the market super quickly in one direction, as you can see with these two candlesticks, how quickly the market moved. When it does that, the algorithm gets messed up and it skips these ticks. And what happens is it needs to come back and it needs to correct the ticks that were missed. Okay? Now, how can you identify where the ticks were missed and where they weren't missed? Well, the market will show you based off of the wicks. All right, so let's dive in and let's look closely at these two impulse candlesticks to the upside. Okay? Now, what you're going to be looking for is you're going to be looking for the wicks. Okay, so actually, let's start right here with this down candle. They sold the market. The market came all the way down here to this wick. And then the next candlestick opened right here, came down. So sellers were in the market to push it down. And then buyers got into the market to push it up. Buyers pushed the market all the way up to this wick right here. And then sellers came in and pushed it right back down. And the market closed right here. Then the next candlestick. The market opened here. There's no wick to the downside. And it was only buyers pushing the market all the way up to this wick. Sellers pushed it back down and closed it out right here. So within this whole candlestick, it is considered only buyers and no sellers inside of this range. So what you want to identify is you want to identify the last time sellers were in the market, right? So right here with this wick, sellers got into the market to push it back down. But once this candlestick opened, only buyers were in the market, pushing the market all the way back up into here. So if we go ahead and we play this out a little bit more, all right, let's get a few more candlesticks going. Perfect. The market pushed all the way back down here. Now, what the market was doing when it came back and it reversed down back here was trying to fix and correct the algorithm. Okay, there's imbalance. Now, what you're going to see is as the market pushed back down here, this wick stopped right in here. This wick right here, sellers pushed the market all the way back down to here. But you guys can see we have a gap between this wick and this wick, right? Sellers were in here and sellers were in here, which means in this area from this line to this line, we still have an area in the market where there was only buyers present. There were not sellers in this area. So that right there is what we call imbalance, insignificant price action, an area in the market that we're expecting to be filled because the algorithm wants to correct itself. All right. Now, the crazy thing with this is you want to identify imbalance right after your institutional candle. So if we go ahead and we back up a little bit, where's our institutional candle? Well, the selling pressure to take the liquidity over here started right up here, right? They pushed the market down. But what's the last down candle before the up move? This candlestick right here. This was the candle that ultimately took all the liquidity over here before it skyrocketed up. So right now, let's go ahead and identify our institutional candle, the last down candle before the up move. We're going to mark up the open, and then we're going to mark up the 50% of the body of that candle. If you want more information on how to identify this, just go to my last video and it will break down how to identify institutional candles. All right, let's go ahead and mark that up. So a lot of people are going to be looking at this area where our institutional candle is at to take a trade, but the market doesn't always play out exactly how we want it to. We could look to play off of an area of imbalance. So looking back at this imbalance, what you want to now do is identify 50% of that range. So from here to here, we're going to identify 50%. There we go. Boom. We can delete the Fibonacci. Now, if the market comes back and it trades in this zone, we can be looking to play off of this 50%. All right. But you want to be careful and don't over leverage your accounts, because the market can still come back to our institutional candle where we can be looking to play off of it as well, right? You want to be patient. You want the market to pan out and do what you want it to do before you enter. For an example, if the market comes back down here, creates a double bottom, right, with equal lows, and then the market comes like this and it plays like that, well, then we would be looking to play off of this imbalance, enter right here at the 50% for the buy opportunity, right? Because we would be expecting these equal lows to be taken out for the market to come down, play in this area, and then reverse back up. All right, let's clean this up a little bit though. Now let's go ahead and play the market out a little bit. Let's see what it did. All right, boom. There you go. The market came all the way back down very quickly, came right into our area and quickly got away. As we continue to play this out, let's see what happened. Boom. There you go. So this was a perfect example of what I was talking about when you don't want to over leverage your accounts and you want to be patient and let the market pan out and do exactly what you want it to do before you enter into a trade. All right, so the market came back down, played into that imbalance real quickly and got away, and then consolidated for a little bit, but then quickly came right back to this imbalance, wicked down into our institutional candle, and then got away very quickly. So in this scenario, you could have entered multiple times. You could have entered one time right here at the imbalance, whether you entered over here or if you missed that, waited for it to come back, right? Stop loss goes right below the institutional candle, right? We could round that up to about 50 pips. And then you could have also entered at the open of the institutional candle. So in this scenario, guys, you would have 3 different times you could have entered the market. 1, the 50% of the imbalance. 2, the open of the institutional candle, and 3, the 50% of the institutional candle. However, it did not come down that far. So we really would have entered at the 50% of the imbalance and the open of the institutional candle. And right now you would be sitting in some profits, move that stop loss to break even. So if it comes back down, you won't lose any money, and take profit at that previous high right over here. Boom. There you go, about 50 pips. All right, so that is all I got when it comes to imbalance. Hopefully I cleared up a few things for you guys on how to identify imbalance, but also how to play off of the imbalance and look for trade opportunities. So signing off, talk to you guys later. Deuces.